Hackers. It's here, and I've got a lot of my other friends on the call as well. I'll bring them in a second. But today we are going to be talking about Index Universal Life. There's been a lot of content out lately. I just got my Vibe board shipped down to the DR, which is cool. I got a new one. Excited to have that here so I get to get into more content. I felt like I've been a little bit handicapped not being able to teach and communicate the way that I like to do. And so it's nice to have that back to be able to, bring this content back up to the level of quality that I want. But today we're going to be talking about a video that Doug Andrew did. Basically, what's the title of this? How to Become Your Own Bank with Index Universal Life Insurance. So tell you out of the gate, you can't do it. And I'm kind of like, it's frustrating to just make these videos and try to educate people. And then, these IUL agents come through and then they respond and they make comments being like, oh, you can. I literally just had, hold on, I'm gonna bring everybody else in so we can do this. I literally just had a person make a comment on one of the videos that I did yesterday, right? And he was, and we started going back and forth. And this is a guy that somehow got my phone number at one point in time. And I don't know why, but I gave this guy a little bit of my time, and then it snowballed. And before you know, he's like texting me all the time. And then I ended up having to block him on my cell phone. He still comments. I still respond to him on the YouTube, but I blocked him on my cell phone because I'm like, this guy is just a freaking troll, and he just wastes my time, and he's just so circular. And it got to the point I was literally getting angry because I'm like, how is this guy this dumb? Like, I just don't understand it. Like, I just feel like I'm wasting my time. And I just don't like to be in that energy state. So I just said, all right, tranquilo, let's just move on. Like, block him from the phone. I even moved down here. I'm like, hey, please don't text me, like WhatsApp me, whatever. And then he kept texting me. He's like, do you not know how to read? Like, hey, he like WhatsApp me once. But anyway, so in that comment though, earlier today, it literally just happened. He's like, infinite banking is all this spread. And I made this comment back to him, like, infinite banking is not just about the spread. Like, you cannot infinite bank with IUL. And I'm sure we'll get into this in this content today. But then he goes, his response to me was like, call it whatever you want. If you're making a spread, you can call it infinite banking, you can call it whatever you want. I'm like, no, obviously you can't just call it whatever you want. Like, infinite banking means something. It stands for something. There's principles outside this spread that you can earn. It's not even about the spread. So the fact that you're trying to make it about that means you're lazy, you're ignorant, you're incompetent. I don't know which it is, but none of it's acceptable to me. And so anyway, this guy, I don't know, he riles me up. He knows all the buttons to push for me. So anyway, so I thought it felt very, very applicable. I should have a conversation with Hutch and at Banking Bros. Hutch is with Banking Bros now. Hutch, the guy who did Banking Truths, you mean, not Banking Bros? I think you meant Banking Truths. What is this? Paired. Who is World Protection Pact? Okay. People are making comments. I don't know what the heck's that about. But So I thought with everything going on today, it would be good to go through here and do a video reacting to, somebody saying that you can use IUL for infinite banking truths. That's what I thought you meant. And so we're going to watch this video of Doug Andrew. It's going to be very, very challenging. I'm going to warn everybody watching this show. I'm going to get fired up. I'm going to probably going to get a little out of line at some point in time during this thing. This is like, it's giving everybody the chance. Like, normally what happens, I do these reaction videos. I have the ability to like watch it ahead of time, and I kind of know. So I get like all the steam that, like would come out of my head. I blow that off like privately so I can be composed when I do it. So you're all going to get the real experience here. So it'll be fun. What do you guys think? You guys excited?
Oh yeah. Glad you're back.
We're all
back here.
This should be fun.
This is going to be fun. So, hey, where's Matt Truschel today? What's going on with him? Slacker.
He's getting a brand new tattoo. I think it said something about IULs. I don't know, but he's certainly getting tatted.
Yes. Funny.
Friends don't sell friends IUL. That's what it says.
Yeah, that one. Okay, that one. We could go with that. So, all right. So here we go. As you guys can see, it is How to Become Your Own Bank with Index Universal Life. So let's watch this, and we'll try to keep it. I'll try to like produce it here. It's going to be hard because I got to bounce from tab to tab to do this. But I think we can pull it off. But here we go. I skipped through the intro and all like the hook, but like we'll just get right into it.
This is a concept that's very intriguing, but frankly, a lot of people do not understand. My goal is to help you understand so you don't miss the boat. So I'm Doug Andrew. I've been a financial strategist and a retirement planning specialist now for 50 years, 5 decades.
If you ever watch his content or read his books, he hasn't been a financial strategist. He's been a IUL salesperson his whole life.
Helping thousands.
Like, he's been writing books for like 30 years of that 50, and it's always been about selling UL. And so, and I encourage, before anybody gets into this, just in case, I encourage anybody that like, for a financial strategist, go Google Doug Andrew lawsuit and, see how good of a strategist he is. It's really good.
Thousands of Americans optimize their assets, minimize taxes, and empower what I call their authentic wealth. Well, my favorite financial vehicle for many reasons is a properly structured, max-funded, indexed universal life. If it's structured correctly and funded properly, it is deemed what I call a laser fund. Laser is an acronym that stands for Liquid Asset Safely Earning Returns. And I've authored 12 books, but my most recent best-selling book that's flying off of our warehouse shelves is called The Laser Fund: How to Diversify and Create the Foundation for a Tax-Free Retirement. It retails for $20 on Amazon. This isn't about trying to sell you a book. In fact, I'm going to gift you a copy of this, so stay with me to the end. You do not need to buy it on Amazon for $20. If you do, thank you, but I'll gift you one, so stay with me. So let's talk about how IUL, if it's structured correctly, is the ultimate tool if you want to become your own banker. But you need to understand, first of all, how money works. And it's amazing how many people do not understand this. There are basically 4 things you can do with money. You can spend it, you can lend it, you can own with it, or give it away. Now, people say, what do you do, Doug? And I go, well, I sort of double dip. I actually loan and own simultaneously on the same money. That always intrigues them, and they go, please explain. Okay. See, when you put your money in a bank or credit union, or even an insurance company, it's in a lended position. Are they just a benevolent institution paying you interest? No. You put your money in a bank and they pay you, let's say, 4.5% interest on a CD. They're not putting your money in some vault and magically coming up with 4.5% interest to pay you every year without putting your money to work. So they invest it, they loan it back out again to you at 7.5%. You take out an equity line of credit, they charge you 7.5%. So they're making 7.5%, and they're only crediting you 4.5%. What's the difference? 3%. That's called a spread. That's called an arbitrage. Now, they have overhead.
So once again, he's trying to say that you can bank with like your IUL policy because you're earning a spread. So he's talking about, I guess, one thing that's important to understand, this is the problem with his marketing, this is the problem with the way he sells it, this is the problem with IUL illustrations, is all he's talking about is the potential to earn the spread, but he's speaking about it like this is going to happen every single year. He doesn't talk about the fact, like I just did an example yesterday in the video that I did that showed somebody that had this quote unquote potential to earn a spread, but the illustration showed earning a positive spread every single year. But the reality is on 1 0 year, they always say 0 is your hero, but they don't talk about the fact that even on 1 0 year, in this one example I showed yesterday, the guy was losing $175,000 off his net cash value, which is the equivalent of a 15% loss on a 0% year, right? Like, so, and this is like using an example of using these loans for real estate. I don't know about you, but this is one of the reasons I say you can't do this and you can't utilize it for infinite banking. And you certainly can't use it for real estate investing because of the fact that you don't want the insurance policy to add more risk to the real estate. And if you're losing 15% on a 0% year in the policy, I don't know. I just see that as a little risky.
Yeah, Chris, I watched that video. I thought it was excellent. And the one thing I will say though is you counted that 15%, but you didn't even count the cost of insurance in that. So the loss was actually worse.
Yeah. I mean, the compound effect of that loss is going to be worse. Yeah. And,
Right.
the future risk of that policy is compoundingly worse. And it's like one bad year like that at the wrong time, it can derail everything, right? Like one bad year like that can set the policy off. And remember, like, and in this example, like I showed, well, I guess not in that example, but I've shown a lot of other examples where it's like you can show the policy being like having positive years every year for 20 years in a row, but then, it's the wheels fall off. Okay, I gotta pause the video for a second because somebody's hold on. I gotta do this. How do I do that? All right, I'm publishing this all myself here. I'm playing producer and everything all by myself here. Here we go. All right, somebody. Superior income distribution and retirement for IULs, better loan rates with a comparable return to whole IUL or to whole life. Reasonable to project a 5.5% gross rate of return in an IUL. I don't think it's reasonable to project a 5.5% gross rate of return in an IUL. If I were you, I'd go watch Life Product Review, and he breaks down, go through his blog. He'll break down why 4.5 to 5%. You have basically the rule of thumb for IUL is about a 50 basis point potential upside compared to whole life. And you say there's income distribution that's superior for IUL compared to whole life. I would tell you that you should never use a life insurance product as a main source of income distribution in retirement. And if you do, no matter what, at least whole life is more predictable. I don't care about what illustrates better. I care about what's actually going to happen in real life and where the risks are. And the problem with a lot of these IUL products is that they do it, and it's exactly what I just talked about. It's like one bad year, and you can a 0 year when you have all these loans that you have to manage with these index loans. When you have all these loans, it injects a ton of risk, and these costs and fees and everything go out of the, through the roof, right? And so he's saying tied to the S&P 500. Okay, yeah, so it's better to use that than the engineered. So if you watch his content, so you're familiar with his premise. Like, I don't know how you watch that and look at the math and understand it, and still, I guess, feel the way that you feel. So that maybe we'll just agree to disagree.
Yeah. I'm going to say this. I mean, no life insurance is a retirement product, period. And that goes for whole life too, right? And that's not what we're talking about. We're not talking about using it as a retirement vehicle or even as a primary source, right? Like we're talking about infinite banking, which is about positioning yourself for success, right? About having a plan and a strategy, and not about using it as a retirement vehicle, but actually just having a foundation that you can build a portfolio around.
Yeah.
Right. And so I think that's where, unfortunately, the IUL agents, they sell it as a retirement vehicle, and life insurance is just a horrible retirement vehicle. It really is.
And that's the thing. It's a volatility buffer, and it can be a great bond alternative, right? Like, I mean, I think in a world where, the 60-40 portfolio is kind of getting destroyed because of the fact that bonds have lost money the same years that stocks and equities have lost money, it puts it in a situation where whole life insurance and the guarantees and the predictability, and I think that's the key, is the predictability of whole life, whereas IUL is not very predictable, right? And so if you're utilizing it as a bond alternative, it's kind of like the reason you can't use bonds right now with the risk that they're going to lose money when the equities lose money. You want an asset that's going to be predictable, that you cannot lose money on. And I think that's the difference. Everybody kind of positions like zero is your hero. You can't lose money, but you can lose money in an IUL, right? Like, he's saying it's superior to other fixed income strategies, has lower sequence of risk. Yeah. What other fixed like strategies? Like I think having equities, having real estate, and having whole life insurance. Like, I just think anytime you're trying to maximize return in a life insurance contract, you're trying to get the life insurance company to do something that they're not great at doing. Life insurance companies, their only job is to get you the best possible rate of return with the least amount of risk possible. Anytime what you do in here, I got to do this. Sorry.
Do it.
So what you do with IUL is you're basically saying, hey, I've got this 10,000. Oh, that's really small. Hold on. What I got is this $10,000, right? And what you're saying to the life insurance company is, all right, we're going to give 1,000 to the cost of insurance, and we're going to give 9,000, to the general fund, so the cash value in the policy. So if the insurance company says, hey, we can get 5% on this, instead of giving that 5%, which is $450 to the whole life, making it $94.50, they're basically saying, we're going to take this, we're going to go buy options, and we're going to risk it. And so that's where they give you the upside potential and downside protection. Is like if the option doesn't come in, well, then you lose the $450. You still got your $9,000, but you're basically saying, let me take the gift and the skill of the life insurance company and what they do best and guarantee this 5%. And we're saying we're just going to handicap them and take risk with that. If you're going to do that, principally speaking, what the hell is even the point? Go do something else.
Yeah.
It makes no sense.
Yeah, no, you know what else doesn't make sense is why would you put somebody between you and your money that doesn't have your best interest in mind? Right.
Oh yeah, but that doesn't make sense. Explain that out. I mean, it makes sense to me, but a lot of people would disagree with that.
Yeah. So
elaborate.
I mean, just strategically, like the fundamental principles of making money, you can follow like Robert Kiyosaki, right? He's going to talk about having control of your assets. You can read Richest Man in Babylon. It's about having somebody that knows what they're doing, but they have your interest in mind. So when you go buy a stock in the stock market, if that company does well, you do well, right? It's a win-win. If you have a financial advisor, right, they're building your portfolio, they work on a fee basis, maybe a fiduciary. If they grow your portfolio, you win, but guess what else grows? Their income, they win. It's a win-win. If you own a whole life insurance policy with a mutual company, you are owner of the mutual company, right? So if the company does well, you win. It's a win-win. And in an IUL, you're a profit center for the insurance company. Now you're on the opposite side of the table. So you're still trying to take advantage of the market. However, you have a third party in between that they're incentivized to not pay out. Yeah. If you lose, they win.
And so, you're 100% right. You're 100% right. And I think that's the challenge with IUL. My biggest problem with IUL is the marketing and the misrepresentation of it. And like all these people out there being like, banks use life insurance and that's why you need an IUL. It's like banks won't even give you a cash value line of credit for your IUL. So why do you think they're buying? Why do you think they're putting their money into it? Like they wouldn't even trust to give you a loan using your cash value to guarantee it, let alone the other guarantees that you would be associated and liable for it. So why would they put their own money into a product? And granted, I've seen a couple companies that'll give a cash value line of credit on an IUL, but they'll only give you 70% of the net cash value, showing the risk associated with it, right? Like, and so it's like, I don't understand like how these people do this, because you got all these agents that are saying, oh, these companies, they've been doing this, and life insurance companies are the most stable companies in the world. But what Michael just said is 1,000% true. It's you with a whole life policy, as long as you pay your premium and the company is still standing and business operational, you're making money, you're partnering with them, you're successful. With an IUL, the company will keep going and your policy could completely fail. And, that doesn't, but that's not the story that everybody said. That's not the story everybody's selling.
Yeah, and by the way, I know you've done a lot of content on this, Chris, but read your contract and look how much control the insurance company has. And keep in mind, they left that there for a reason, for their own protection. And they're incentivized, like I said, they win when you lose. Think about it.
So the argument is that an IUL, according to Dionate, sorry about that, an IUL is a better vessel in your retirement. Now, I counter that saying, why would you add risk to your retirement, especially if you're already in a 401k, which is exposed to a lot of risk? An IUL is a risky product, and it becomes more risky in your retirement when you're starting to take withdrawals from it. right? 2 down years could derail the whole thing. So you're taking on that risk. You're increasing the risk of, if it does detonate on you, now you have this huge tax liability, and that all happens in your retirement. So it's a much better strategy to utilize your whole life policy as the safe vessel of your money. And then you can have your equities money, and you could even potentially ride that with a higher risk profile. But because you have that safe money, you'll have a better return on your money. And Dr. Wade Pfau has done multiple white papers on this and run Monte Carlo simulations saying, hey, by utilizing your equities, your 401k, and the whole life policy, you'll have a way better outcome. He doesn't say anything about the IUL chassis. So that argument, I think, is completely debunked right there.
One of the things that I think is really important here, and I'm talking to this to Deontay here. Hopefully I'm pronouncing that right. I do want to be respectful of his name. But the one thing that's really important, and listen, this is conjecture. It's not even conjecture. I mean, it's you're gonna have to take my word on it, and people are just going to agree to disagree with me on this. If you don't like it, if you don't like what I have to say, you know, you're just going to find a reason to want to, you know, disagree with me, I guess. But the bottom line is, when I was at the company that I was with, and as a director of business development, and having conversations with the leadership, with the executive teams, with the head of the career channel, with the head of like all independent brokerage and all these different things, the thing that I learned was and think about this. Back then, use common sense, guys. Common sense goes a long ways. I don't care about all the speculation. I don't care about all the like opinions. Just use common sense. We were going into a world where the fixed rate market was going down. That was putting stress on the whole life companies. Regulation 7702 updates and the reduction of the 4% guarantee to, you know, to spread it between 2 and 3 3/4, you know, depending on the company, that shows, you know, that stress existed. When you look at the fact that from that period of time, these general fund managers, you know, they realized we were going to this long-term low interest rate environment, that there was going to be a lot of stress on the general fund. And the guarantees that these companies had to meet was a massive, massive stress and liability. I had these conversations. The reason that there were only 7 companies when I started selling IUL selling it, 14 companies when I left selling IUL and left the big company, and now there are over 70 companies selling it, is because of the fact that it's a more profitable product to sell. There's more control for the insurance company, and there's less risk. And I know that because that is the story. Because don't forget, National Life Group, guys, I said it, there we go. So they're one of the oldest mutual companies. They were one of the oldest mutual companies in the business, right? They'd been selling whole life insurance since 1842, right? And so they shifted because of these reasons. And if you think they're the only company that shifted for those reasons, like, I got a bridge to sell you in Brooklyn, right? I'll give you a good deal. Or in Baltimore, that's a better one. You know, it's it is what it is. Like, it's insane. Like, I do not understand how people just can't break it down and just look at the process, you know. And I don't understand hey, what's up, Matt? So I don't understand how people don't just see that and have it make sense, right? I don't understand how, you know, we're looking at it now. We look at like the history of how this stuff has played out. You know, the results for IULs have never matched. They've never matched like what they've promised to match. You know, he's saying that when you're selling IUL cap rates, when they were 14 and 15%, it's wildly different compared to now. It's completely unrealistic. It's not unrealistic. It was unrealistic. It was economic and environment. Like, if you understand what causes the cap rates, they don't just set a cap rate. That's the thing. Like, everybody needs to understand this. They don't just set a cap rate. Okay, here we go. I got to do this again. Sorry. We may not get to this video today. I don't know what's happening.
I don't think we will either.
But like, I want
to keep going.
This is really important though. Like, so this is really important because like Deontay here is saying, and Deontay, by the way, thank you for the engagement because I love this stuff. you know, like, so here's the deal. So when we look at cap rates, we have to understand why they're set, right? So we have to think about cap rates are created because of the general fund, right? Like what we have an options budget, right? If we understand how that happens. So I'll just do this. Is like, okay, we go back up here. We have the $10,000 budget. It goes there. We have our general fund, which produces the 450. I'll clean this up a little bit so it's cleaner. How about that? So we have the $9,000 kicking out in this example. I'm just going to do 5% just for simplicity, and we'll say it's $500 in the general fund. So they take this. This is the options budget, right? And then so the options budget goes and they buy call options. So the call options are then utilized. You know, the question is, what's the cost of the call options? That nobody knows, right? Nobody knows what the cost is. The cost, there's some variables here. The cost can go up, the cost can go down. The general fund can go up in performance. This is 5%. It could go down to 4.5%, and the performance will go down, right? So this variable, you know, we don't know whether it's, you know, this variable or this variable that's going to change, but these are two variables that can change that are outside of the insurance company's control. So when they go, oh, it's wildly different selling, it's wildly different selling at a 14 and 15% cap rate. The problem is the 14 and 15% cap rate were based on these variables, and the economy didn't cooperate. You know, the variables that life insurance companies solved or created their own problem, because here's the biggest change is fixed market now is going up, but the biggest change from 2014 to today, the call options have gotten way more expensive. Do you know why? Because of the fact that they're a supply-demand product, right? If call options, you know, when we go back to life insurance company, when they had like, you know, millions of dollars going into these products, and you had millions of dollars chasing the available S&P 500 call options, well, that's one thing, right? Like, because now the cost of options is going to be lower. But and that was with 14 companies. Now you have 70 plus companies going after the same pool of call options, and instead of millions of dollars, you're talking about billions of dollars, literally billions of dollars going after these things. That's driving the cost of the call options up, right? And so the problem here is IUL companies are creating their own problem. The more popular they get, they've driven rates down. That's why during the greatest bull run of all time, they've had to reduce and reduce and reduce cap rates, even when interest rates were going down little by little by little, right? Like, because they were, but they stayed pretty flat. We were in this long-term, low-rate interest environment, but they weren't going down that drastically from 2014 to 2020. They weren't. The thing that was going drastic was the cost of options were going up drastically because of the competition, the supply and demand nature of them. And so now when we talk about this and we go into this and we say, all right, what could happen now? Let's talk about the fixed market. Let's just break it down. And we say fixed market, interest rates, basically the federal funds rate, 10-year treasury rates, right? So is it fair to say that the rates can go up, they could go down, or they could stay the same? Fair? Anybody think of any other option?
No.
No?
Nope.
Okay. So fixed market can go up, it can go down and stay the same. So if the fixed market goes up, what does it do? It for options budget. If the fixed market goes up, options budget increases potentially, right? Or you know, the options budget will increase with the fixed market. If it goes down, it reduces. If it stays the same, it's the same, right? So now what happens? We have to look at this and we have to say, okay, now we have to look at this and we have to take it to the next level. We have to say, all right, if the fixed market goes up, historically speaking, what does that do to market performance? Historically speaking, now these are all rules of thumb, and in a short-term window, you're never going to get it completely right, but we always have to be thinking long-term. But in a longer-term rate environment, when interest rates are going up and we go into a long-term, and there's usually a couple, and we go into a long-term increasing or elevated interest rate environment, that usually leads to market performance being reduced or going down, i.e. loss. You're going to have loss. And so so let me translate that. If the fixed market goes up, increasing the options budget, it's going to increase the options budget. But what's going to happen is it doesn't matter. Even if your cap rate goes up, if the S&P 500 loses money, do you really win? No, you're still getting nothing. Does that make sense?
Yep.
Okay. So if the interest rate goes down, maybe the market does better, right? Because what happens is that's what they do. That's why the 80s and 90s are so popular, because we had these high interest rates. Rates went down. When rates go down, it injects more money into the economy, right? So the options budget might go down, but what it's going to do is the market performance is going to go up. You're going to win. You're going to gain, right? So in this situation, though, when the interest rate goes down, because of this nature, just this one variable, right? I'm not even getting into the options cost yet. Just this one variable. If options cost, I'm assuming in this explanation that the options costs all remain equal, right? And that's it. So if that's the case, we go here, the $500 options budget, if that went down to say $450, it's going to reduce the options budget. And typically speaking, the market's going to go up. But if the market performs better, let's say your 10% cap rate goes down to 9%, like you still lose because the potential is hampered by 10%. People don't make it realize that's a big deal. Like if cap rates are 11 and they go down to 9.5, that's like 15%, reduction. That's a big on the potential, return on the high end of these policies. It's a huge deal. And if it stays the same, obviously it stays the same. And then the real variable when it stays the same is that options cost. Are they going to go up or down? And the reality is there's two things that go into options cost. It's really one thing, but there's a couple variables that go into it. So options cost is all supply and demand. Supply and demand, right? That's the biggest variable for options cost. Now, there's two things that cause this supply demand to be out of whack, or that have caused problems. You're going to have a situation where we have more IUL companies flooding the market, right? And they're going to be going after and chasing the same supply. And then B, when we have market volatility is going to lead to elevated rates too, because the more volatile the market, the more popular the options traders want to play the game. And so when that happens, the supply goes down as well. You got more money chasing the same supply. That drives options costs up, and that will reduce cap rates. And so no matter what we look at, whether interest rates go up, if they go up, it's going to put a lot of stress on economies, on markets. The compound effect of the fact that rates will go, even though the budget's up, or the options costs are going to go up, which will, even if fixed rates and the options budget goes up, that's usually going to be countered. And all the while, the reduction in the actual performance of the S&P 500, for instance, will be hurt. Now, exactly what I just showed you here, that reason, I'll say this, that reason is exactly why all these companies, when Regulation AG 49A came out, that is the reason that these companies like Nationwide and Pac Life and Symmetra and Allianz started coming out with all their engineered indexes with no real historical data, but with back testing and all these little nuanced things that they added into it, right? And so that's the biggest problem, and they did that because what happened was all the S&P 500 rates went through the roof. So they're like, well, how do we control our options costs a little bit? Let's create these engineered indexes and make them look really sexy and make them look like, if we could cherry pick stocks and, returns. Volatility controlled indexes are crap. Yeah, they are. They're trash for sure. So I wasn't reading his comments while I was talking because my back was to the computer. Anybody see anything? Can you guys see the comments, by the way?
Yeah, one thing he did put in there was talking about the options costs, and to answer that, I mean, all you have to do is go to the market and look at the options costs of, say, Visa, which is a less volatile stock, compared to Tesla, and you can see the difference.
Well,
anytime.
So one of the things, and I want to do this just to end my little rant here. One of the things that I would say here is like, Deontay here is saying, all right, I just showed this, right? And this to me is why I think IUL is doomed over the next 10 to 15 years, because we are in this economy where, it's no matter what happens, whether the fixed market goes up or whether it goes down or whether it stays the same, the options cost, the budgets, I think the environment and the market performance and the combination of the two. I just did an interview with John Wolfenbarger, from Bull and Bear Profits, and he says Warren Buffett's number one indicator about stock valuations and equity performance says that the market is so overpriced right now that PE ratios are the highest they've been since 1929, and that the valuations of companies are so out of whack that Warren Buffett's favorite metric says that stocks are going to be worth 50% less than they are today 12 years from now. Think about that number. Think about that number for a second. So if that's the case, what are we even talking about? All this crap doesn't matter. I should just erase it all, right? It's all pointless, because if the market is going to be worth 50% less, what's the point of even having an index at all? You're going to get nothing for it. Whereas whole life insurance, no matter what, you're partnered with the company, you're going to win. So I would anybody that wants to do this, you buy a policy, I'll buy a policy, and we'll see, start right now, 15 years from now, I'll bet you $100,000 that the whole life outperforms the IUL. Because environmentally speaking, moving forward, when you understand that with a whole life policy, you are partnering with the company, right? And if the fixed market goes up, there's one variable. I think, is it fair to say that the rates are probably not going to go as low as they were? Again, anytime in our lifetime. I don't see a 2.5% mortgage rate coming around anytime soon. Do you guys?
Nope.
Okay. So it's fair to say if the rates stay the same or go up, if inflation keeps getting out of control, remember, I always say, got to align your money with values and beliefs. If you believe inflation is going to rear its ugly head again, which I do, if you believe all these challenges in the economy is going to go down, which I do, if you believe all the things that I've been talking about, well, then whole life is the biggest no-brainer winner, because long-term now, they're going to just plot along and predictably get you that 4.5%, 5%. And it's going to, over the next, 10 years, it's not going to be sexy, but it's going to grow. All the while, IUL, you have the potential to have the same. And I have no idea. I don't even know how to draw out what I'm thinking right now. So I don't know why I'm doing this anymore. But all the while, you have IUL that's sitting there that if you want to do IUL, what are you doing? You're taking potentially 50 basis points of more potential mathematically, and you're injecting a ton of risk. So for me, when I make my decisions through the lens of what's the upside, what's the downside, can I live with the downside, is the upside is 50 basis points of higher long-term potential. But in order to get that 50 basis points of more potential, I'm going to take all this risk on. And I'm just going to put my entire financial future on the line. I'm going to put my entire legacy on the line. I'm going to put my entire future of my family at risk. And people think I'm being extreme when I say that, but it's ridiculous. It's ridiculous. But see, Deontay, this is so fun. I love this.
He's like the new Brian.
No, it's great. No, but these are good questions. So I love this. So the Fed has two choices: cut rates or major market crash. Which do I think Chairman Powell will do? I think there's a lot of variables in that. I think a smart person lets the market crash. I don't think he'll do that. I think he'll cut rates. But if he cuts rates, caps are coming down. And if the caps come down, see, now you're playing right into me. If caps come down, IULs are garbage, right? And so what do you say here? 80 to 190% overvalue. You agree. However, okay. So what? Decline in market value. Okay. But even if the stock market doesn't go down in 50%, even if it stayed level, even if it's where it is today, 12 years from now, I mean, this wouldn't be the first time people lost 10 to 15 years of market performance, right? Look at, when the market crashed in 1929, it took till the mid 1950s to basically get back to even, right? So it's not. This is simply not true. If a whole life policy both earn 5% gross, here's the other thing: IULs also have these crazy surrender charges that are way worse, and early liquidity. And there's an opportunity cost to not having that early liquidity. I know he's going to say you could do things to design it the same, but it's still not the same. Cost structure of an IUL is massively cheaper for the first 20 years. That's actually not true. If you're young, that is true. If you're old, there are ways to design a whole life insurance to be more efficient, because the cost of the annual renewable term will rear its ugly head. that's just what it is. And plus, you know, whole life is going to have better guarantees when you look at that, like, and you look at the fact that there's value there. And if you look at the midline projections, I mean, we could design, yeah, I mean, that's probably a whole different video. So anyway, let me see, because I want to get back to this video. It's going to be a longer video today. Hopefully everybody's good. Okay, so we got that. Anybody good? Anybody else from Deontay have questions or comments?
Well, I know one of the things he said is the IUL should not be compared to equities. It should strictly be compared to whole life and other fixed incomes. I would love to see an agent sell a client without comparing IULs to equities. Like, oh, it's better than your 401k. It's better than the market. And try to sell an IUL compared to whole life and actually disclose all the variables and the risk, the lack of control in the IUL. And the client says, that makes sense for additional 50 basis points. Yes. Please, I would love to sit in a room and see what that sounds like, because I cannot believe anybody that's logical would actually buy an IUL compared to whole life.
I love this.
When we're not even comparing equities.
I know.
And so when he says, I don't hear any sound reasoning as to why I shouldn't sell IUL, I'm gonna assume he says sell IUL. He says do IUL. Well, that's because you're more interested in selling IUL, not identifying what the client's needs are and what the values are. That's why.
Anybody that
did that, most people wouldn't even get an IUL.
Anybody that sells a lot of IUL negates the risks or downplays what the actual risks are in the IUL, and you know that's just reality. What's the average cost of a loan in a whole life policy right now? We have a company we can get a loan right now at like 5.2%. So regardless, what's the actual cost of a loan? What's the actual cost of a loan in an IUL? It just depends on what the market does, because cost is all relevant in an IUL to what the performance is. Because if the market, if you take a 5% loan in an IUL and the market does 5%, well, then it's a wash. But if you lose 5%, the cost of that loan goes through the roof, right? So you can't. And then if you do a wash loan, you're not eating into the net amount at risk. And so then the cost of insurance as you get older, when you're in retirement, using it for retirement income, that goes up. And so it all comes, there's always a catch with IUL. He says that he thinks I'm a bit exaggerated and a fearmonger. I'm not. Like, how is anything I've said here fearmongering?
It's very objective. I mean,
I didn't say he was
clearly attributes of an IUL. It's undisputable.
Yeah,
and
I mean,
when this is what kills me is when agents say, well, what's the loan rate of a whole life policy? So like, you want to argue what's better based on the loan rate. So I could do wash here and participating loan, and then this one's 5%. So therefore IUL is better than whole life. Let's even remove all the attributes, the upsides and all the loans and all this stuff. Let's just talk about the risk. And I can almost guarantee it. And if you sold any client and we went through the risks, most clients would say, I would rather take a 5% loan than all these risks and the potential of a participating loan and a wash loan. That's what they don't understand, is they're trying to compare all the values and features, but they don't understand is like you left out the biggest part, which is all the risk and the variables, which the clients have no clue. I can't imagine one IUL agent that actually goes through the potential risks and variables in an IUL with a client, because I can't imagine any client ever buying it. Please, if somebody has a recording of actually going through this, I want to hear what a logical person would say with all the variables and all the risks. I would love to hear the word tracks on that. Please.
Do you notice? And like, listen, Deontay, like I really, truly do. I like the questions, Deontay. And I enjoy, I can't tell you, this is like my favorite thing to do. I could talk about this stuff all day. But what I would say is, like, Matt just kind of hit the nail on the head, in the sense that, like, I've yet to see somebody read a full illustration on, like, as an IUL agent, and like use the full illustration as a marketing tool, right? To go through and be like, hey, check out this 72-page illustration, and let's read through all the disclaimers on how the insurance company has more control about this and all the different variables. And by the way, look at this little paragraph here that says, when you take loans, it dramatically increases the chances of your policy lapsing. And so, and look at this phrase where, as soon as you take a loan in the first 20 years, your guaranteed insurability rider gets thrown out the window. Look at this. if your policy lapses before the age of 75, by the way, there's the overloan protection rider. By the way, if that happens and you overloan before you're 75 and these things happen, that overloan protection rider gets thrown out the window. And so now you get hit with a big taxable consequence. Like all these different things, like you read through all the ways that these people sell IULs, and then you read the illustration, you're like, oh, by the way, there's a catch, 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 there's a catch. And you're like, like if you were to actually do that, and if you were to, listen, if you can go through and you can sell, Deontay, you can sell your clients and guide them through and walk them through and have them read every line on the illustration and then still be comfortable to buy the IUL, well, then God bless you. Have fun. You're amazing. Like I got to, like, you're amazing. But I would say this is like anybody selling IUL over whole life, to me, you say you're product agnostic, and I enjoy your questions, Deontay, but my only real hardcore pushback at you right now would be, I have a hard time believing you're product agnostic. I think what you mean in being agnostic is meaning I will sell whole life and I will sell IUL, but I really have a hard leaning towards IUL. Right? That's what your definition of agnostic is, which is based on the statement that I'm hearing and the engagement that I'm seeing. I'm not saying that's necessarily all the way, but that's what I'm seeing. Because otherwise, you know, it just doesn't seem to make sense to me. But I'm full agreement with both of you gentlemen regarding the sales practices of the majority of agents selling IUL. That's still not a valid argument to discredit IUL as an asset. I mean, Deontay, we just came through the greatest bull run of all time. 10 years, like whatever. Show me one IUL illustration that you've done, you know, that a client that you sold in the greatest bull run of all time with a product, with a company, with a client, you know, that was supposed to, if a product is supposed to give upside potential, we just got the greatest bull run of all time. Show me the upside potential. If you couldn't take advantage of upside potential in the greatest bull run of all time, what are you doing? So there's two things. And Deontay, I don't know you. I don't know how long you've been doing this business. I don't know, like, you know, how short of a time you've been doing the business, or like what your real experience or background is. Like, so, you know, take this for what it's worth, but show me one person. If you could do it, not only I'll give you $2,500 if you could show me one example of it working. Otherwise, my answer, and I'm gonna plant my flag hardcore on this one. My answer is you haven't been doing this long enough to really have a hardcore opinion. It's one of two things. You either haven't been doing this long enough to know what you're talking about and to actually experience long-term results, and it's all speculative, in which case you're speculating and you're putting everybody's money at risk on speculation, on a speculative strategy, or you have been doing it long enough and you should have real-world success stories that show that the product does what it says it's going to do, or you don't. Like, how do you argue? I don't know how anybody, like, this is the part about this, like, all these IUL agents are like, I don't know how.
Well, he got his license in 2021, if anybody's wondering.
He did?
Yeah.
Oh, okay.
Well,
so
I'll say this too. He also exposed himself at 11:26. He said IULs have no risk. So obviously he just doesn't know. He just doesn't know.
I know. But, you know, I do think out of all IUL agents, I do like a lot of his, you know, comments, and, you know, I think he's probably, you know, better than many, but I've been in the industry for 4 years. I can connect with my mentor. He's showed me a few IULs for me that average real rate of return of 8% over what time frame? That's the thing. You know, and that's your mentor. So he's ready to have a live discussion. So I would be interested in, you know, this is the thing, doing an 8% return. What were they illustrated at, first of all? Because that's relevant. It's super relevant, because it's always going to be relevant, you know, to the environment that I just showed, and how these things are calculated, right? That's what you have to think about. And when you think about it like that, and when you look at the returns, and like your mentor showed you a few, like maybe look at all the ones that he doesn't, like, you know what I mean? Like, that's the thing. The thing that drives me nuts that I see with these IUL agents that do this is, it's like they see a couple and they go, oh, I've seen 2 of them that worked. They must be amazing. They got like, these things are like, just because 2 out of like 1,000 worked, you know, it's one of these things is like, You know, Doug Andrew makes these videos and he's like, oh, I've got 8 illustrations that, you know, showed that they worked. It's like, listen, I've said this, I don't know how many times at this point in time, but it's like, I'm not saying that they can't work. I've never said IULs can't work. So Deontay, make sure you understand what I'm saying. I'm not saying it's not possible that in a vacuum, in a perfect, all things being, you know, taken into consideration, that an IUL, its potential to work is there. It has a potential to work. However, your airplane that you get on has the potential to get where you're going. If your airplane had a 5 to 10% chance of getting where you're going, are you going to get on that airplane? I don't know. I think Jeff is a risk taker. Jeff, would you get on that airplane?
No.
So your mentor has a Series 7 and runs an RIA. I don't care. Like, what? Why do I care about that? Your mentor should have the ability to open his book of policies to you and let you do like an audit and look through in-force illustrations for a lot of people that have policies 10 years ago. And if you were to do your real true due diligence, that's what you would ask for, to see like what percentage actually work, not just give him the opportunity to cherry pick a couple policies and show it to you. You know, I have no data to substantiate that an IUL will only work 5 to 10% of the time. There's actually a lot of LIMR data. There's a lot of data that shows, and go look at lapsed from Elon Moaz. It's not shock value. Just go look at these companies. And if you go look at the companies that are dealing with the class action lawsuits that are settled and sealed in arbitration that don't even become public, you look at all the things that are happening every single year that have happened. It's ridiculous. What is it? Oh, he happened to show them to me at a meeting with the agent. Of course he did. You know, that's he's got to sell you on the idea. So
we used to do that at WFG all the time.
So he didn't allow Deontay to cherry pick, but he cherry picked him, right?
Yeah. So all right.
I think there's a good book, Chris. I'll make the recommendation for anybody watching, but Money Master the Game. By Tony Robbins, right? And the reason I'm bringing it up is because he talks about mutual funds in there. And he says 96% of mutual funds do not outperform the market, right? But there's 4% that do, right? And it's kind of the same thing that we're talking about here. It's like, yeah, there are a few that have outperformed the illustration. I've seen them, right? And I know which ones they are, right? However, when you break down the how they got there and the strategies, they're actually not very sound strategy. Like they're not the smartest strategies, right? They might be like on a 5-year index. And when you really understand indexing, ideally you would lock it in as often as possible. If you could lock it in every day, the gains you would, right? So it's kind of like saying, yeah, we hit it, but is it fundamentally sound? Like you could have, what's the stock that people made a bunch of money? GameStop. Like, yeah, people won on GameStop. Cool. But it wasn't a fundamentally sound like bet, right? Like you wouldn't bank your future on it. And so it's not that it can't perform. It's just, it's not something you would want to bank your future on. And you know, like I said, hey, maybe 4% do outperform, right? I know of a couple.
Let's say 30%. Let's say I'm wrong and it's not 10% or 5%. Let's say it's 30% will actually perform. Are you willing to take a 70% chance? Because I guarantee you, I would bet my entire life. You could put a gun to my head right now, and I guarantee you, not more than 30% of these things perform. Like I know it's not more than 10%, but like it's red herring after red herring. Yeah, like I you know what I think is funny? He's literally sitting here being like, I do my own research. And like, if his research is like, I saw 2 illustrations that actually worked, like I saw 2 policies that actually worked, like, and that's his research. Like, and he's like, we're red herring after red herring. And he's in this, like, and when we're challenging him, like to like do his research and really dig deeper, his response was, I saw 2 policies that worked. And so I know these things are good. It's like the level of, I know he says he's really logical, but that doesn't seem logical. It seems like somebody that was seeking confirmation bias and just like, hey, show me one thing, just give me a little chance to run with this, and I'm gonna go with it. That's what I see. What's the primary driver of policy lapses? There's a lot of drivers in policy lapses. Policy lapses happen because of lack of premium payments, because of the fact that people, the flexibility, which is sold as one of the most positive attributes of IUL, is one of the greatest problems with IUL. That level of flexibility causes more problems with the policies than anything else. I would say that. I would say the fact that the costs, he's saying I didn't say that. I mean, that's pretty much exactly, just read through the comments. Anybody that's watching, that's basically what you were saying. The cost of the insurance, the lack of performance, the cost of the insurance that go up when the policies don't perform well. You know, when you and I think the greatest risk for I think the greatest risk for IUL actually exists when you have policy loans out. That when you take policy loans out and you have that loan risk added on to everything, the compound effect that these things have the ability to implode is like through the roof. And you know, I just think it's really interesting is like nobody, all the people like Deontay here that are selling these like they're these safe, guaranteed, like no risk. I won't say guaranteed, but no risk, which if there's no risk, isn't that got to be guaranteed, right? Like if there's no risk in them, then you know, they sell them like that, but yet there's no, like, show me one person that has taken this no risk strategy, show me one person that has executed this no risk strategy in your entire, like, show me one success story with somebody that's had the policy and that's used it for 10 years of income, 5 years of income. Show me successfully funding the policy and used it for just 5 years of income. Just show me one person. Out of surrender period, all this stuff. They can't do it. It's speculative. Like anything aside from that is speculative, yet we're the red herring. We're the ones who are, you know, coming up with
show me the data, right? Show me the data. Well, where's your data?
Show me real world scenario. I will put my life and my reputation on the line, you know, and my clients' financial futures and their legacy. Like, I'm not going to speculate with that. I'm going to go and I'm going to use a strategy and a product that has been used for 180 years and successful with companies. You know, it is what it is. It is what it is. Index Universal Life has only been out 27 years and the majority of products haven't been out longer than 15. It's not a disingenuous argument because the burden of proof is on the success. Anything until then is speculative. And when you look at the products that actually have been in existence and how poorly they've performed and how poorly VUL has performed historically and how poorly UL has performed historically and how the UL companies that now sell IUL and how those companies performed from 1980 to 1999 and how those UL companies that are the same companies selling IUL now, how they treated their policyholders after the UL debacle. If you think it's going to be any different with IUL, man, I don't know. I don't know what to tell you. Like, the level of emotional confirmation bias that these people seek is crazy. It's crazy. It's like, even what he's saying now is like, I know, you know, that there are multiple indexed universal life insurance policies that have performed outstanding. Outstanding? No, I know that there are some that have performed from a long-term basis that have beat illustrated assumptions. That I wouldn't classify that as outstanding. I know there have been a couple policies that have had an outstanding year. But I'm not buying an IUL. If I were to buy one, I wouldn't buy one. But if I were to buy one, I'm not buying it because I'm expecting it to have a good year. I'm buying it because what's it going to do for me over a 20 to 30 year period of time? What's it going to do for me? How's it going to help me with everything else that I want to do? How's it going to help me be a better real estate investor? How's it going to help me, you know, with major capital purchases? How's it going to help me in retirement? Where are the risks? And if it's not, you know, like where is it potentially going to let me down? And if it's not going to work when I need it to work, and does help me solve the problems when I need those problems solved, then I don't want it. And if it's too risky or more risky in those ways, then it's a problem. You know, I'll watch the video. I'm moving fast, so if I fumbled a little something, I'm doing this live, so give me a little grace. I don't know what to tell you. I'm not your opposition or the enemy. I'm also not the ideologue that's bashing the product to promote another product. Okay. I don't know what to tell you. I always think it's funny that people think I bash IUL to sell whole life when I've been bashing IUL since I got into a lawsuit with the company that I left because they tried to like get me to shut up and not share the stuff that I share. And that's why I talk about it. I had the choice to give up my insurance license and keep talking, or keep selling and keep my mouth shut. And I decided to give up my license from 2016 to 2022. And from 2016 to 2022, go look at my channel. I made all these IUL education videos to get people aware of this because of the fact that I believed in it. I had nothing to sell. So if you think I'm creating this content just to sell my whole life insurance, do some research, figure it out.
But Chris, obviously it was a big plan for 4 years to create content without a license. And
obviously, I love spending all that. Yeah, I'm really good at playing the long game, apparently. It's just like, it's just insane. So, hey, do you guys want to watch a video?
Well, I want to say this. I also say, like, it's not bashing. It's like, let's be honest. Let's just be honest about it, right? Because you're not saying IUL can't work in certain situations, right? Like maybe a guarantee to age 120, like North American has. It's going to give you a specific death benefit. It's going to work, right? Because it's contractually guaranteed, right? So there are certain cases where it can work, but to call it a retirement vehicle, to sell it as for income, like, let's be honest about the risk involved, right? And for you to say there's no risk, Deontay, by the way,
so
I got this to say: explain the guarantee column, and not that the guarantee column is likely to happen, but explain it. Because if there's no risk, you wouldn't have a zero or lapse policy in the guarantee column.
Exactly. And so check this out. He says the premium chassis, meaning the amount of premium that can be paid into an index universal life policy for the same amount of death benefit and whole life, is much higher. So here's what he's saying is, like, you're going to get more death benefit with IUL. That's what he's saying. You're going to get more death benefit with your payment into an IUL policy than a whole life policy. So he's also, the insinuation that he's been talking about the whole time is saying the insurance company is going to give you better returns, more death benefit, the same liquidity, all the benefits and all, like, whatever. It's like they're going to give you all this stuff. And by the way, they pay a higher commission for IUL. They pay, they do all these things. It's like, if you believe that, it's almost like I can't help you, right? Like, if you truly believe that story, that the insurance company has the ability to give you all of those amazing features and benefits, and that it's all these things, and there's no downside to it for the insurance company, like, do you think the insurance company would still be in business if that were the case? They cannot give you all of those things with no cost associated with it. And the cost associated with it is a lack of control. And the insurance company has the control. And this is what I'm saying. Like I always say, it's like, you're not, hold on. He's saying that's not what I'm saying. He's saying the opposite. He's saying you get more death benefit for whole life. No, that's actually not true though. You can get more, equal apples to apples premium payments in comparable design. You're going to get more insurance in an IUL. I mean, it's pretty close to the same if you design them equally from a blend perspective, or like from a target overfunding or a base and PUA kind of blend. They're going to be pretty comparable because of Section 7702. But anyway, the amount of insurance required for a specified amount of premium is lower. Yeah, I mean, the amount of insurance, well, because they're using an annual renewable term, but that number goes way through the roof. It's lower out the door. It's lower early years. But once again, if you're buying it for retirement income, let's talk about the fact that you can never pay an IUL up. An IUL is always going to have they have vanishing premiums in IULs, but you can actually pay up a whole life policy. and reduce that risk. And so, that's what am I not saying? What am I not being clear on, guys? What am I not being clear on? I feel like I'm being clear. Am I being clear?
Pretty clear. Yeah.
Okay.
That was English to me.
Yeah.
Okay. Apparently, I'm not being clear. If Deontay, if I need to restate something, just let me know specifically what I'm not being clear about, please. But yeah, okay. But did I not just say that, like, out the door, the first early years, an IUL is considerably cheaper? Once again, do I care about that? No, I care about the life. Hey guys, question for you. Are we buying a whole life or an IUL for 20 years, or are we buying it for our entire lives?
No client would ever buy it for 20 years. They're buying it for.
So do I care about the cost of insurance for the first 20 years, or do I care about the cost of insurance and the total expenses of the policy for the lifetime of the contract?
The whole shebang.
So why are we talking about the first 20 years?
Because that's how they're trained. That's how they sell it.
Okay.
Because they don't talk about the risk. They don't talk about the big picture for the clients. It's always like a side door. With IUL agents, they always have side doors. You throw out one challenge, they say, but you could do this. You throw out one challenge, but you could do it this way. You throw out this challenge, but you could tweak it this way and rebalance, and you could turn this up to the left, to the right. All these like little maneuvers. Did you explain that to the client? Does the client have to do that? Are you going to be around long enough to even actually help the client do that? All these little maneuvers and buttons you got to press and these switches you got to flick on and flick off. It's like exhausting.
Matt, I've had a similar experience. When you challenge people, it's like whack-a-mole. It's like one thing pops up, and then it's something, and then it's a lot of minutia. Quite frankly, it's these little details about the policy that can be changed in an insignificant way that can make a difference in one policy or one specific product for one carrier. And I think to kind of summarize what we've been talking about and our position, as I see it, and I guess my position, as I'll speak for myself, is in coming to this. I mean, just being quite frank, as somebody who's relatively new to the industry, it's like just looking at the whole picture. It's like IULs have been around for almost 30 years. You would expect, and especially over the last 15 years, there have been hundreds of thousands of IULs sold. And with the performance of the market over that period of time, you would expect all, if not most, if not all of those policies to be performing really well in comparison to their original illustrated rate. And the fact is, there's very few that anybody can show as an example of policies that are doing that and have performed that well over that long period of time. And something else that's come up is like, and when I say that to IUL agents I've spoken with, they're like, well, show me the proof that only that 90% of them will fail. Where's the proof of all these failed IULs? And it's like, okay, yeah, the burden of proof is not on me. And like, who is going to continue to fund a policy that is not performing well for a long period of time? Either they don't like money, or they're going to continue to fund these policies that aren't doing what they thought they were supposed to do for 10 years just so they could lose money and prove a point. It's like the evidence that people selling IULs are asking for doesn't exist. And why would it? It's a silly argument, in my opinion.
Yeah.
I just asked Deontay, like, wait, what's he saying here? Using logic, when you consider the amount of IUL sold versus the amount of lawsuits or complaints in existence, it's fair to conclude that the majority of clients are satisfied. No, it's not actually fair to. It's fair to assume that their annual statements are confusing and not transparent. It's fair to assume, just like what happened with UL, people have no clue what the hell's going on until they get a lapse notice. That's what's clear. It's clear to assume that statement just seeks more confirmation bias, and that you're using deductive reasoning to seek confirmation bias, when in reality, if you look at history and actual results and what has happened with actual real life examples of a very similar scenario with the same exact companies with the same chassis product, even though it wasn't indexed, and how it happened and what happened with the policyholders, and then the lapses, and how the insurance companies weren't transparent with showing them their statements, and then these people didn't get notified or weren't even aware that there was an issue or that they were at risk of an issue until they actually got a lapse notice. Do you think it's any different? It took a lot of those people, 2 decades to actually become aware of it. What history? What actual results? Are you talking about the UL history? That's a joke, right? Like, are you trying to sit there and pretend that like the whole UL history didn't exist? Hey, Matt. What's up, buddy? Yeah, like LinkedIn me. Yeah, LinkedIn message me, email Chris@Life180. I'll do this with anybody. Any IUL agent, I love this. This is like probably the thing that fires me up the most. Any IUL agent that feels like you can do this, and you've sold yourself on it, build me your best IUL illustration. And the one that you've used to sell yourself on this, the one that you've used to convince yourself that you're doing the right things for your clients, send it to me, and then come on live with me, and I'll do an evaluation with you of this illustration, and I'll show you where the problems are, and we'll go from there. The only thing I want a picture of your face when you realize, that you were wrong. I want you on camera. That's the only rule.
This is great. This is great. Hopefully he takes you up on
nobody's hurting my feelings. Nobody's hurting my feelings. People are just, being what they are. Nobody. I got thick skin. Gaslighting is ineffective. Okay, shoot it to me, man. If anybody's open to it, I'm game. I would love nothing more.
Yeah, well, okay, he's open to it.
And I'm always like, I've had people send me things where I'm like, holy crap, that was creative. Like, it's not going to really work, but I really appreciate the ingenuity and the creativity. It is what it is. So what do you think, guys? We're like an hour and 12 minutes already. This video did not go the way I thought it was going to go. I'm not going to lie.
I think it was more productive actually going through the
danger.
chat,
The danger of being live, I guess, sometimes, right? Like, this did not go the way I thought it was going to go.
I think this is good though, because it goes to show like this is how it typically is with any IUL agent. They'll, like you said, they'll pivot like the whack-a-mole. And what ends up happening in most cases too, you just pay attention. They'll pivot again and they'll make a new adjustment, but then it contradicts. And I've done this with our old buddy Brian, and I'm sure you can see it in some other videos too. But then it's like, wait, but you said this earlier, and now you're like changing it back. And there's always like there's can't even think of the word, but it's not congruent, right? It doesn't make sense. It's like, well, you can't have it both ways.
So I love this. He's saying like it's not going to really work just because Chris said so. That's just his reasoning. And listen, guys, anybody watching this video, I don't care if you're an agent or you're somebody looking to buy IUL or somebody that has an IUL. Listen, I got two emails today from clients that have IULs that like watched my video on the Allianz IUL, and we're like, holy crap, like I just watched this video, and what you said is exactly what happened, and I need to figure out what to do about it because it's totally doing exactly what you said, and whatever. So I need to figure out whatever. And so now I got to help these two people like figure out what they're going to do with these products, and figure out how much money they're going to have to lose because of the surrender charges, and like not keep throwing good money after bad, and then figure out where's the balance with all the surrender charges versus the loss of the current surrender charges, and keep paying into it, and potential future surrender charges, and what's the reduction in surrender charges as it goes on, and like this whole balance of it all, right? He says that it's not going to work just because I say it is, and it's just my reasoning, and I agree with him. Like, I'm like, listen, nobody has a crystal ball. I showed you earlier. If you're just getting here, go watch a replay and watch the math I did and show how the options work and the options budget and the general fund and all these different things and how the economy reacts typically in the S&P 500 index and all. Do your own reasoning. Like, think critically. Be an adult. Like, nobody should just follow my reasoning. Do your own research. And listen, I'm totally cool with the fact if Deontay has a completely different set of reasoning at the end of the day, cool. Like go follow Deontay's reasoning if that's what you want. You know, as long as you make an educated decision and you don't just follow a salesperson, you know, myself included. Like I don't like I'm whatever. Like as long as you truly believe that you're making an educated decision for yourself, well, guess what? You're a grown person. And you will live with the decisions that you make. And at least you're not going to look back being like, oh, I got hoodwinked. Like you have to go through a process where you feel super confident and confident that you're going to do it and that it's going to be right for you. And my sound reasoning, the reason I consider my reasoning sound is because when you read IUL illustration and you actually take their warning seriously, you go, holy crap, I'm not going to do this. You know, I had a mentor one time. I had this like really bad habit of like trusting people too much, and I kept getting burned, right? And one of my mentors came up to me and goes, Chris, here's the problem. You always want to trust people too much. When somebody tells you who they are and shows you who they are, you need to believe them, right? And so I apply that to the IUL illustration game. The insurance companies are telling you what they're going to do in the illustration. Believe them. Believe them. It's not a mistake, you know? Pac Life is in a lawsuit right now over some of their IULs and their Horizon IUL, and they tried to get the case thrown out, being like, look at the illustration. Like the illustration says all the things that these guys are complaining about. It says in the illustration they could happen, and the judge didn't let them throw the case out because they said that those terms were not in good faith. Like the sale is not in good faith, and like you need to have like a law degree to understand and like go through or have the discipline to read a full IUL illustration. According to my logic, all the IUL carriers are scamming the consumer base. No, that's not it at all. IUL companies are not scamming the consumer base, but make no mistake about it, in an IUL, the obligation for the insurance company is to not make the IUL policy whole. It's to make the company profitable. It's to pay shareholders. And if it's a mutual company, it's to take care of the mutual guarantees, the people that are participating in the mutual guarantees, which by the way is never the IUL. IUL is a profit center. That's why I like whole life. Philosophically, fundamentally, when you sign on the dotted line with a whole life policy, you are partnering with the most successful long-term financial company in the history of our country. Even though I'm not in the country right now, you know, like you're partnering with that company. With an IUL, you're becoming a profit center for that company. Make no mistake about it. I'm not saying they're trying to scam people, and I'm not saying they're ever intentionally going to stick it to the policyholders, but I'm saying when push comes to shove, their obligation is not to those policyholders. And if you think that's not a big deal, you're in the wrong place. Stop wasting your time here. I'm just going to drive you crazy. That's the reality. All right, everybody say something.
All right, Chris, I've been silent here just observing, and I think really what it comes down to, and I see this so much across the board with, you know, whether it's IUL agents or whether it's financial advisors, they're focused on like rate of return and cherry picking these specific arguments when we're not trying to chase rate of return with a whole life policy. We're not trying to get the most death benefit for the lowest premium. Like that is not our goal. There is a deeper strategy with all of this. There's more efficiencies built into this. And if you remove the rate of return and the illustration from the IUL discussion, I just don't know what else there is to sell on. I don't know what other benefits there really are if you're not trying to push this whatever rate of return that you're going to get. If you take that off the table, and I know we've talked about this before, if you take that part off the table, at the end of the day, what is left that a client is so drawn to an IUL that's going to make a difference in all different aspects of their life? It's going to go with them through their whole life and be this foundational asset that's going to make everything they do better. That is, to me, what it boils down to. You can argue, well, my loan rate's better than yours, and it doesn't matter at the end of the day. That just does not matter. It really comes down to strategy and why we use these products. And we use these products because they've been around for so long. I think Deontay said it exactly. Like the IUL industry has only been around for less than 30 years. And that's exactly why we use whole life, because it has the dependability. It has the predictability that we're after for a strong financial foundation. And I guess if I'm the other way around, Deontay, please share with me. I'm open to learning. I don't think I know it all. I would love to understand different viewpoints and really understand this. But from everything that I've seen, from any IUL book I've read, any IUL channel on YouTube that I watch, there's just not a whole lot there other than the main things that you're pitching around, cherry picking things or the rate of return argument. I'm open, Deontay. Share with us, educate us. We're open, man.
Well, I think you just hit the nail on the head too. So cheaper costs. So he just went through this. So cheaper costs, not cheaper costs. Cheaper costs for the first 20 years, not cheaper costs for the lifetime of the contract. Okay.
That's objective.
That is objective. That is
objective, logical,
yep. Okay.
Logical and objective.
So, flexibility. The number one. It's funny that he'll say that's one of the benefits. They use that as one of the benefits. I will show you how a whole life policy can be almost as flexible with not the risk that comes along with the flexibility of an IUL. If you think that flexibility is a benefit, I would argue that whole life insurance is almost as flexible, and the level of extra additional flexibility of an IUL is like going to be creating problems, right? Like better living benefits, depending on what company you go with. The companies we use have just as good living benefits, and you can find whole life insurance companies if living benefits are priority are there. Better loan rates, once again, no. That's speculative, because the loan rate isn't just what's the cost of the loan, it's how's the policy performing in the back end, and on a down year, what's the actual cost of that loan going to be. So if you have $1 million loan at 5% out on the policy because you've taken $100,000 a year of income for a period of time, and now you got $100 million of outstanding loans, you got a $50,000 loan expense. Well, if the index does 5%, well, that's going to wash out. If it does 0, now you got a $50,000 extra expense, right? So the actual cost is what matters the most. So loan rates, that's one of the biggest.
I feel like the biggest misconception there is the flexibility between agents, because with the whole life, you can set it up just think of like an IUL. Obviously, there's different components to it. There's paid up additions, but in the IUL, you have your, maybe you set it up at guideline premium to fund it, right? And then you have your target and your minimum premiums. And the client, if needed, they can go down to the target. They can go down or anywhere in between, right? But let's say they go down to a minimum payment because they have issues at their job, right? Or something happens. And so the problem with the flexibility in the IUL is if you go down to minimum payment, you're going to end up with a lapse policy. So it's really not that flexible, right? Whereas if you had the whole life and you had it, funded in the PUAs, and you said, oh, let me go down to a minimum premium, which is very comparable. Guess what? Your policy is still growing. There's no dangers of it lapsing because of, didn't perform, and you're still earning dividends, right? And so it's still working for you. There's not that risk involved in that flexibility of the premium. And I think that's kind of the biggest misconception I see when it comes to IUL agents saying IUL is more flexible. It's really not, because if you want to use that flexibility, you will end up with a lapse premium or lapse policy doing that too long, for sure.
So this is my frustration with those cookie cutter.
Yeah, Matt, you look really frustrated right now.
Here's my frustration.
You're looking at your face.
It's not gas.
I'm gonna give you the floor.
And by the way, it's not gaslighting when I'm identifying patterns that I've observed, and you might mistake gaslighting for passion and elevated voice because I'm passionate about it. But just as well that you like to list out all the positives and the benefits, please, we'll stand by, list out every potential risk that the client should be aware of before they sign on the dotted line. And we'll just wait. Every single potential risk that you feel when you sell that policy, the client should know. It's in the best interest of the client to know. List every single potential risk, and then let's start from there.
Yeah. Here's my thing. And I think it was something Michael was saying. It was either Michael or Jeff just said it. That I think is really important to understand is, and listen, Deontay said this earlier too. Life insurance should never be a retirement income vehicle, right? Like it can be an asset in retirement, like a volatility buffer that's going to help. It's a bond alternative for whole life insurance because of the guarantees that it comes with. It can be used in like very unique, creative ways to solve different problems. But we're never trying to create wealth. This is the biggest difference. Like, there's so many people that try to position life insurance as like the secret tool the wealthy use to get to create wealth, and it's like, that's bullshit. Like, pardon, but like it just is. They don't use it. And I've done interviews with Garrett Gunderson on this. We've talked about this before, and it's life insurance is not the tool you use to create wealth. It's like, you're going to create wealth you're going to create wealth in other areas. Life insurance should be the backstop to your wealth. It should be the thing that protects your wealth. That's why it's used as a volatility buffer, so you can have your other assets perform better. Use it on negative years to be there to enhance the performance. Dr. Wade Pfau, he was saying earlier, Dr. Wade Pfau did this thing that basically said, by having a whole life policy in place during retirement as a bond alternative, as a volatility buffer, it's going to help the rest of your assets perform potentially 25% better?
25 to 50% better.
25 to 50% better. Okay. And by the way, that's math, that's science, that's backed up with a history and a track record of data, right? Don't believe me? I'm not the one who did the stats. Go watch Dr. Wade Pfau, and well, don't watch him or listen to him, but go read his book. It's phenomenal. It's phenomenal. That's there. Go do that. That's why I'm so high on utilizing whole life insurance and real estate and business and things of that nature, because I'm not trying. I think the wheels fall off the argument because everybody's like, rate of return, rate of return, rate of return. You got to be willing to sacrifice the potential rate of return for the security, the control, and the predictability that comes along with a whole life chassis. That predictability is going to enable me to be better in my real estate investments, right? I did a response yesterday that shows if I have real estate properties and I've got a policy loan in my whole life insurance policy out on those, and let's say I have, and in this example, I was following this video. I was responding, and go watch the video I did yesterday, reacting to Money Mythbusters clown video. But he had like $4.2 million of loans out for real estate, and he was saying specifically, like, use these policy loans to buy real estate. If that's the case, in this example that I used, a down year added $175,000 of extra expenses that year because of interest expense. Now, you don't have to pay that. It'll come out of your cash value, but that's the equivalent of a 15% loss of the net cash value that I have left in the policy. And if that happens, I promise you, what you're doing by using an IUL instead of a whole life policy is you're injecting more risk into the real estate portfolio that you're building, which is, by the way, the exact asset that you're trying to use to actually create wealth. You're not trying to use the whole life policy or the IUL. And if you are, you're making a mistake. I'm telling you right now, you're not trying to use insurance to create wealth unless you die, in which case, if you do, I'll tell you what, here's when an IUL is good. If you die in the first year, you plan on dying in the first couple of years, go get an IUL. You're going to make out. Your family will make out. They'll get more death benefit. It'll be great. Cost of insurance will be lower. Everybody wins. Just die. You'll be good. If you plan on living and being productive, it's not an argument. Like, it's not. See you, Jeff. You know what I'm saying? Like, when we look at it like that and we say we should not be utilizing life insurance to create wealth. It's the backstop to our wealth. It is the thing that's going to help us complete our plan should something go wrong, right? And we need that asset. This is why IUL doesn't work for infinite banking, because the predictability doesn't exist. It's not about a spread. It's not about a potential arbitrage. It's about the predictability of the asset that we're using to be the foundation to enhance our other stuff, to be there as a backstop, right? We need it to be predictable. Just like in the economy, the more predictable the economy is, the more predictable our politicians are, the more predictable the Fed is, the more consumer sentiment is positive, the more investment goes up, the more the market goes up. When unpredictability comes in, asset prices come down. It's just the way the world works. Yep. So why would we want to take an asset that's going to inject more unpredictability into the things that we're trying to use to create wealth? Like, break that down. Really think about that. Why would we ever do that? You know what I mean?
Yeah, Chris, I'm going to play devil's advocate here a little bit because I want you to explain something, because I already know what the argument against what you just said is going to be, and it's, well, certain IULs have a guaranteed loan rate of maybe 5%, right?
Whatever.
And I want you to dive into this because I think what people forget is the loans, they go to the insurance company. and it's adds profit to the insurance company. And where does that profit go? Well, right back into the dividend, right? So who does that go to? It goes to the whole life policyholders, right? So it kind of doesn't matter from a whole life. And I know you did a video on this, so that's why I said I want you to explain. But if we take a direct recognition or a non-direct recognition, it doesn't really matter too much.
Mm-hmm.
Right?
Yeah, I mean, it's interesting because the like when you take a loan from a whole life policy, I think, and I'm gonna pivot your question because when you said it, I thought of something else.
Okay.
And I'll answer it, but I also got to answer this thing that's in my mind before I forget to bring it up. When you borrow against an IUL, and remember, you're never taking money out of your policy and borrowing that. You're using your policy as collateral, and the insurance company you're paying the interest to. So when I pay the insurance company, let's say I take an IUL loan and I pay 5%, I'm paying the insurance company that 5%, and that's like a lost, like that's not directly coming back into the policy. I mean, sure, it's going to go like the insurance company keeps it, but you're not participating in the success of whatever that loan rate is, right? And the fact that it's low, they can give that lower loan rate maybe and guarantee that to be, say, maybe capped at 5% because of the fact that they have more control in other areas. Like, once again, these insurance companies, if you think they're giving you that benefit of a lower interest rate with no cost or no catch, like that's just not how insurance companies work, right? And the thing is that it is a pure 5% cost because you're not participating in the profitability of that loan. When I borrow against my policy with a whole life policy, that is an asset on the general fund of the life insurance company, and that comes back and it increases and has an impact on dividend rates. And dividend rates, it will then in turn potentially increase the dividend, right? And so when you look at it like that, like I'm not worried about, it's always relative. Once again, it comes back down to predictability. The loan rates with whole life are always going to be relative to an extent of the dividend rates, always going to be relative to the fixed market, and it's always going to put us in a position where we have more predictability and more control of this asset that's going to help enhance other things that we have going on. That is what taking control of the banking function of your life is. That is what we're talking about with infinite banking and utilizing this asset to do of whole life insurance to go out and invest in real estate, to go out and invest in business, to go out and buy our cars and do all these things. It's not about the arbitrage and the spread that's illustrated on an illustration, which, by the way, they illustrate with positive spread, but there's a reason that regulators keep updating the IUL illustration laws is because they're all bullcrap. They just never perform the way that they're illustrated. So, Regulation AG 49 in 2015, 49A in 2020, and 49B in May of 2023. Like, these are things that, and by the way, there's going to be a Regulation AG 49C, I'm sure, within no time. I know they're working on it already because every time they come up with a new regulation to change the way these illustrations are allowed to be made, these insurance companies pivot and they come up with a way to work around it because they got really smart actuaries because they don't care how the policies perform. It's all illustration warfare. That's all it is. How can we illustrate the best returns? Because nobody's going to read the illustration. They're just going to look at the ledger, and salespeople are going to sell off that, and they're going to say it's conservative, even though it's not. And that is what it is. I have a video coming out Friday called "The 6 Lies Agents Are Using to Sell IUL in 2024," and it's going to be awesome. It's an hour long. I'm going to warn everybody, but it's super hardcore. And I go into super depth on illustrations and everything. And I think it's going to be good. So did I answer your question or did I not?
No, you did. And I wanted you to get into that because, like I said, I already know that's the next argument, right? If I can lock in this interest rate.
Yeah. Ian, you've been quiet, buddy.
Yeah, I'm just looking at the comments from our friend Deontay. IUL should always be very conservatively designed. Yeah, in the real world, that's just not the case. I mean, we've all been in the industry. I came into WFG. None of the IULs that were being designed were conservative in any way whatsoever. And not max funded, everything. And when he talks about the issues with IUL, agents overestimating projected returns. Well, what percentage of IULs are experiencing that? The majority of them. And the third point that he comes up with is designing policies in an overly aggressive manner that a client, where are we at here, couldn't maintain in the event of an income shock. Like those two things alone, like realistically, how many IULs that are being sold today are being designed conservatively and in a way that aren't being estimated in a way that they're not estimating projected returns that are overly aggressive. It's like very, very few. And I think that's, in an ideal world, yeah, IULs could work if that was the case, but that's just not the case, not the reality that I see when people come to me with IULs. I don't know about anybody else on the panel here, but how many IULs are you seeing that are coming to you with people who are like, oh, this is really conservatively constructed?
It never happens. I mean, I never see it. I mean, very rarely.
Yeah.
I shouldn't say never, but like 1% of the time, maybe. And here's the deal. He's saying that IUL is cheaper, than whole life. How did he say it? He said, I don't remember what he said. I can't find his comment. But he basically said, oh, IUL is cheaper than whole life is because the onus of the guarantees are on the life insurance company with whole life, and therefore you don't have to have the guarantees with IUL, so you can have cheaper death benefit. But the bottom line is, that plays into the reasoning. It's cheaper for sure, but the fact is the reason it's cheaper is because if you buy it young, you're buying annual renewable term. So if I'm 44 years old right now and I'm saying I'm just paying for my insurance every single year based on an annual renewable term chassis, well, at 44, buying insurance for 1 year for $500,000 of insurance is going to be cheap because they know the risk of me dying this year after going through underwriting at 44 for ART is super cheap. It's super affordable. With whole life, it's going to be more expensive because they're like, guess what? You're buying this for your entire life, right? And the actuarially speaking, if you get to mortality levels, meaning if I'm 44 and my expected life expectancy is say 84 years old, IUL for the same amount of insurance, if I'm using an increasing death benefit and then I shift to level death benefit in retirement while I'm taking all this out, but let's say I have $500,000 death benefit and that goes up and whatever, then at 84 years old, at mortality age, IUL is going to be more expensive. And the thing is in those ages where IUL, the wheels fall off, is because as I get to 72, 73, 74, 75, and I'm doing ART, annual renewable term, which is what happens, the cost of insurance is super expensive. And when that happens and you have policy loans out because of the fact that, you're using it for income, so you have policy loans out, and then when the market doesn't do well, and you're not paying for the interest on those policy loans, and then your net cash value is going down every year, and now your cost of insurance is going up, and because the policy doesn't perform well, this creates this compounding effect, and everybody thinks like IUL is like, listen, I'm not going to argue with Deontay here and say like IULs in down years or whatever, while you're accumulating money, and if you're not taking loans against them and whatever, they're not going to like destroy your financial life. That has never been my argument. My argument has been they're not providing the same upside potential that they're claimed to have. And my argument is they're the riskiest and they create the most problems for you when you use them the most for what people are telling you should be using them for, i.e. real estate investing, tax-free income, business loans, all those things. Those are when IULs are the riskiest. And and especially for tax-free income, because then your age and the ART and the fact that you can never pay it up. The fact is I could use a whole life insurance policy and Will it perform? Will it have as much cash value as an IUL? I would say, based on what I said earlier, yeah, I think it will over the next 10 to 15 years. Okay, because of the environment that we're in. Do I know? No. Does Deontay know? No, he doesn't. We're all speculating. Use your own sound reasoning. Come to a conclusion. Make a decision. You're an adult. Okay, fine. Make a decision. But do I know? Do you know? No, nobody knows. But what I do know is that with a whole life policy, I can pick some of these policies and some of these companies where I can have it purely paid up at 65 years old. So when I hit retirement and when I want to take income, it's going to be more efficient because I have no more insurance charges, no more expenses, no more anything. If I want to do a withdrawal to basis and loans above and beyond that when I need to as a volatility buffer, it's going to be much more efficient because I have no cost dragging it. I have no cost adding to the risks that go along with it of the insurance costs that are the annual renewable term that is with the IUL platform that never goes away. I don't know if everybody knows this. I mean, I know Deontay knows this, so I'm not talking to him, but all the people watching. Just because it shows a 0 on your premium column on your IUL doesn't mean there's not a cost coming out. It's there. It's there. There's vanishing premiums. You can never eliminate the costs in an IUL. That's why we have to think long term. Think about it. Use just sound reasoning. Are you buying? We've done this before. We're buying the policy for our entire life, not for 20 years, Deontay. Okay? So if I could buy a policy right now at 44 years old and have it completely paid up in a whole life policy by 65 when I plan on using it, like say for a volatility buffer, let's say I was buying it as just a volatility buffer as a bond alternative, and that's what I wanted it for. And I said, I know I could get 5% with an IUL, but what if I could just get 4.5% here? But at 65, it's paid up in my whole life policy, right? And I eliminate that risk in retirement. Is there not value there in reducing that risk and taking that risk completely off the table? You know what I mean? And so to think that like we're going to be able to get that value and get that benefit and also have it be just as cheap, that's just stupidity. You're technically correct, but there's something called the necessary premium test, which essentially limits the amount of premium that can be paid into an IUL. The necessary premium test, which limits the amount of premium that can be paid into an IUL. Well, it depends on how you have it designed, and that's always going to come into the design. What does essentially is implying that you've paid enough premium cumulatively into the policy to cover the cost of the remainder of the contract, although it's not a guarantee. You're never, no. Oh my gosh, here we go with whack-a-mole, Ian says. Like, yeah, it's like, listen, you can never pay up. There's always going to be a corridor of term insurance costs that you can never have the IUL completely paid up. You can reduce the premium based on the design. You are not going to eliminate the cost of insurance. There's always going to be some insurance cost, some drag on the policy. It's unavoidable. It's there. It's the way they're designed. This is not an opinion. This is not up for debate. This is what the chassis is. This is how the product works. I know you know this. Now you're stretching here, Deontay. Come on, you're better.
That whack-a-mole stuff I was talking about.
So, all right. What else we got? Okay, so I guess next time, guys, we're gonna have to get into this Doug Andrew video. We made it through like what? How far did we make it through? We made it through 3 minutes.
Oh man.
We made it through 3 minutes.
We will do better next time.
We will do better.
Yeah.
So anyway, hopefully, I mean, I had fun. This was fun. I enjoy these kinds of engagements.
Yeah, Brian on the same time. We'll probably be here 4 hours.
Imagine him and Brian. I want to be disagreeable. I don't want to be disagreeable. I don't want to be disagreeable, but I'm right. I'm right. What I'm saying is actually factual and real.
Well, he's submitting a conservative IUL statement and you guys are going live, right?
Yeah, I'm happy to.
Isn't
yeah,
that okay?
Deontay, send me at chris@life180.com. Let's set up a time. You send me an illustration and we'll break it down. I'll upload it on my Vibe board and we'll go live and we'll talk about it.
This is awesome. You're disagreeable, Chris.
I don't like, if I was disagreeable there, I apologize. My intent was to not just be disagreeable at that point in time. That was, I'm referring to the MPT test, which limits the premium, both CVAT and GP. Yeah. So, okay. So, but at different corridors. Okay. So like, okay, that's fine. But like the principle doesn't change the fact that you can never pay up the IUL, period. Like that's, you know, when you shift it, the problem with IUL, here I go continuing this conversation. So the problem is when you illustrate an IUL and you shift it from option B increasing to option A level at retirement, and then you illustrate income, it illustrates at 50 basis points of positive arbitrage. And when you shifted that from option B to option A, that 50 basis points of arbitrage always cuts into the net amount at risk, which cuts down and reduces all the insurance charges. But in reality, that's not how it actually plays out in real life. That's the problem. That's why regulation AG 49B is going to get updated. And that's, you know, it like eventually my guess is, and what I was told by Bobby Samuelson, is he thinks we're going to get to a point where IUL illustrations are not going to be able to be allowed to illustrate more than 5 years out potentially because of the fact that they get so misrepresented. Who knows where that will go? You know, and my concern is, you know, he also said it may go that way for whole life insurance too, which, you know what, I'm totally fine with, because of the fact that like whole life is predictable. It's such an easy story to communicate, and it's not confusing at all, right? IUL becomes paid up on an IUL design with a GPT B to A with max reduction by age 95, but that is just illustration. Yes, exactly. It becomes paid up at night. Like if everything goes perfect to illustration. Hey, Matt, what's up, buddy?
Hey.
You know, IUL does have, like, according to the illustration, it gets paid. Hey guys, by the way, did you know that if an IUL has positive year every single year from now until you're 95 years old, it has the ability to be completely paid up at 95?
Wow, that's all?
Every
single year? That's it?
Positive year every single year.
Sounds good.
That's pretty cool.
Good to go.
Client should know about that.
Yep. No way this roast is done. Bro, we're in it for the win today. We are going. This is the longest live I've done in a long time. I'm having fun. This is great.
This is way better than watching a Doug Andrews video.
Yeah, that old snake oil salesman.
Yeah, I know.
Plus,
maybe I'll just record that video.
Plus, we get all this promotion of the channel. Thanks, Deontay.
This is great. I mean, yeah, it's still happening. It's still going on, man. It's still going on. You know, yeah, I mean, I feel like the only thing we're missing is Brian. Brian, can you imagine Brian being on this at the same time with him? That would have been epic. That would have been epic. All right. Well, anybody else got anything? I don't know why I'm feeling like I could just keep answering questions. Anybody in the feed watching have any questions? I went to the gym and back home, and you guys are it's awesome. I love this. But we still got people here. So as long as people are here and have questions, you know, I'm happy to engage.
I think these conversations are important to have, and for people just watching and being able to witness as an observer, because it becomes very apparent that they become very circular, and it really gets down into the weeds and into very specific details of very specific situations. And when you zoom out and look at the whole thing, it still doesn't make sense.
What's interesting to what you just said there, Ian, is like I met you at a World Financial Group event, right? And so like, I don't know how I'm building the bridge between what you just said and that, but like it's just where my mind went. And so like I met you at this World Financial Group event. You were brought into the industry because of IUL. And I, you know, it's really just a values thing, and it's a beliefs thing. And it's like when we come from a place of core values and like what we're trying to accomplish in life and like what risks we're trying to take off the table. I'm never going to sit here and say that the potential of IUL doesn't have the potential to be there. It's just the predictability of the actual result. You know, I've been in my new book I'm writing, and, you know, I'm starting to do more stuff around this and build a whole talk about it. Stop thinking about rate of return and start thinking about rate of result, and thinking about like actually like returns don't matter. Like speculation and spreadsheets and illustrations and projections and pro formas and all these things, they don't matter. It's not real, right? Past performance is not indicative of future results. Go read any one of them. That's what it says, right? And so they don't matter. We need to start thinking about results. And the only way you're going to be able to really think about that is like, how do you build a foundation? And then how do you put yourself at the epicenter to be able to control those results to a certain extent, to create a life that you want to create, whatever it is. Money is just a tool for us to live the life that we want to live, right? Like, and when we're just chasing this return and that's all we're doing, we're basically giving up the control of us achieving a desired result to somebody else, and allows us to scapegoat it when we don't reach our goals because somebody else just didn't do their job. That retirement, the economy did this. Jerome Powell's an idiot, and I can't believe he did that. And like, because of that, all my investments lost money, and the real estate market did this, and the stock market did that, and like, you know, whatever. When you really break it down and you start thinking about like, hey, I have the ability to go build a financial foundation with an asset that will be self-completing if anything happens, that will have guarantees, that will be there, that I can leverage to go and find opportunity to invest in myself, to invest in real estate, to invest in business, to like be there as a foundation that will allow me to take risks with other money because I have this financial foundation. And because I have it, it gives me the confidence and the power, the empowerment to be able to go do this stuff. That's what this is about. And if anybody's thinking it's anything more than that, it's not. And if you're thinking it's more than that, you're trying to chase these big returns, it's not. You got to be thinking about building structurally, using this asset to be the foundation, and then go and then building on top of it with other assets, with other investments, with other, you know, risk taking. It's not that you can't take that it's not that you're not going to have to take risk to accomplish and achieve what you want to achieve and to live the life that you want to live, and like whatever, depending on what you want to, you know, do and what you want your life to look like, there's going to be, you know, more or less risk that you have to take to get there. You know what I mean? And it depends on what you're dealing with from a cash flow perspective right now. But it really just comes down to the fact that, you know, I would challenge anybody to think about, are you in control? Like, are you structurally set up so you're in at the epicenter of the control of the results in your life financially? And are you really using money as a tool structurally to do that? Or are you going with IUL and hoping that they're going to get you a better return and get you that result? You know, once again, the argument there to me is a broken argument. It's the same argument of like, I mean, how many IUL agents say, you know what, IUL is a better 401k?
Yeah.
All you're doing is you're transitioning the risk from the government to the insurance company, and the insurance company's already proven with traditional UL policies what they're going to do long term. We've already had that conversation. And so if that's the case, like, it's still a zero-sum game. We're still saying, I'm going to put money into this asset. This asset's going to perform better than whole life. And so it's going to get a better return. And so then it's going to provide more tax-free income in retirement. That's how they're sold, even though it's not accurate how it'll actually work. But the idea is I give to the insurance, I take it from the 401k and all the income that would create, and I give it to the insurance company. They're just going to do the job for me. It's not really solving the problem. You're really still not taking accountability. Now, the one good thing that IUL has over 401k is, once again, if you die, it will self-complete. You know, if you die soon. But if you live too long with an IUL, it'll be worse because of the loan risk and because of all the things that happen there.
Yeah, Chris, I think the biggest thing is we have to fix the lens that we're even looking through, right?
Totally.
I know Ian, Matt, and myself, we all started at WFG. So thank you, WFG, for getting us in the industry.
You're idiots.
And even you, Chris, like you sold IUL, right? Like we all got in.
Gotcha. Charles is the only smart one.
Dang. Yep. He's the only smart guy in the call. We reached him early enough.
I didn't fall into the trap.
Well, what I'm trying to say is we got in and we got shown, okay, IUL as a retirement vehicle, right? And so I think what happens, a lot of agents, they continue to look at the two as, okay, what's the better retirement vehicle? They're looking at it with that wrong lens because, like I said, whole life is not a retirement vehicle either, right? So it's like, you're going to look at it, you're like, oh, that's not a good retirement vehicle. You're right, it's not. but it's because you're looking at the wrong lens. So like when I sit with my clients, it's like exactly what you were just saying, Chris. It's not the retirement vehicle. It's not the investment. We're going to go build a portfolio of investments around this. This is the safe money. This is where it's stored, right? We want this to be the last of our worries if we're utilizing this to go out and build, right?
100%.
And when you start to look at it from the right as a foundation, and you understand you don't want the risk in that, then things start to make sense, right? You want the predictability. It's important.
Totally.
Because the last thing you want to do is now you're leveraged, right? Leverage is risk, by the way, right? So you're leveraged. The last thing you want is to worry about the foundation falling apart. And it's probably not going to happen unless you're over leveraged, but still it's there, right? And you surrender fees. From the IUL perspective, the liquidity is a little different. You can be very liquid in a whole life policy. And so it's like, what are we trying to accomplish? And if we look at it through the right lens, well, then whole life all of a sudden makes a whole lot more sense. And so I think sometimes it's the perspective and the lens you're looking through. And that's the problem with a lot of the IUL agents that get into the industry, because they're looking at it as a retirement vehicle still. And the truth is they're right. Whole life doesn't make a great retirement vehicle, right? But you got to focus on what are we trying to accomplish. The positive arbitrage is not within the policy. The positive arbitrage is what we do with the money outside the policy.
Totally.
Right.
And if you look at it through that lens, then that's where IUL falls apart, because the positive return outside the policy, when you're borrowing against the contract on down years where you can create more opportunity in other areas, you could actually inject more risk in the IUL and add more expenses. And that's exactly the opposite of what you're going for. Yet now potentially you could have years with an IUL where you earn more than you are charged, and that's fine, but like the risk, once again, it's predictability and risk. And the worst thing that could happen is when you have that extra risk added on negative years, when maybe other assets that you're taking the risk on are not performing as well as you wanted them to, which is going to happen from time to time. If you do this long enough, you're not going to get it right every single year. The worst thing that could happen is you have this asset that you're relying on and depending on to perform, and then boom, it adds an extra 5% cost to everything you're doing, when in a lot of people's situations that 5% margin or additional expense could be like a torpedo that sinks the ship. So anyhow, fun stuff, gentlemen. We're almost 2 hours. I'm like tempted to just like stay on here for 2 minutes, just get to 2 hours.
A 5-hour marathon.
We're an hour 57 minutes.
Michael, call Brian. Let's get him on.
Where's Brian? So all right. So here's what I want to do. Everybody, pitch yourself for a second. Matt, everybody go to @Matt Seibert, right? And subscribe to Matt if you haven't yet. Michael, what's your channel?
It's IC Life.
@IC Life. And Ian Vogel is @Ian Vogel Media, right?
Correct. Yes. Thank you.
Got it. Yeah. So guys, everybody go check them out. Obviously this is live, so I can put if you're watching the replay, I'll put their links in the description below. But everybody go check them out. If you're watching on a different platform, you're watching on LinkedIn, because we're kind of all over the map right now. We got some people on Facebook, got some people on YouTube, got some people on LinkedIn. So just go to YouTube and follow them on YouTube. If you haven't already, go to YouTube and follow Life 180 as well. Click on the bell, get notified every time we do this. I got a lot of really good videos over the last week. I got a video, when is it? I think Sunday I scheduled it. I just launched a video about what is financial efficiency. When we just did this mastermind this week, my wife kept being like, you guys keep using this term financial efficiency. Like, what the hell does that even mean? And I was like, babe, you've been married to me the entire time I've been in this business, and you can't describe financial efficiency. I'm in trouble. I've done something way wrong. So in inspiration, I made a video for my wife about financial efficiency. So I'd invite everybody to come watch it on Sunday. It'll be going live at noon Eastern time on Sunday. And go there and watch that. That'll be coming out. And then, but yeah, no, in all seriousness, so if anybody has an IUL, if you're looking to figure out how to utilize life insurance as an asset foundationally in your life to figure out, how to help you in the ways that we're talking about. I'm not I'm not hardcore on wanting to sell all this stuff or whatever. I just believe everybody, listen to Deontay and come up with your own reasoning, and if you don't think our reasoning is sound on why we do what we do, and then call Deontay. He'd love to work with you, it's just, to me, and that's what it is. I really, really, really encourage everybody to think critically, to challenge, the status quo of the ways of thinking around, all this money stuff, and that's where, like, I have a challenge with people like Doug Andrews, because, like, if you read Doug Andrews' books and you listen to the problems, he and I agree on 98% of the problem, right? Like, that's the solution is where we disagree, because, when you look at the solution compared to the problems, and then you look at the risks that he doesn't even address in the solution, you realize it's not really solving the problem, right? And you're just shifting the risk from one problem to another, and it's not really solving the issue. And so that's why I love doing what we do. That's why I love working with people and helping them see it. It inspires me to see people when they have the light come on and they get it for the first time. Nelson Nash always said, infinite banking isn't something you learn, it's something you catch, right? And it just, all of a sudden you study it, doesn't make sense. And that's why I beat the horse like I do online here. And, like, I'll say the same things. This is why I give so much time and attention to people like Deontay who do it. And people give me a hard time all the time. It's like, why do you spend so much time engaging with people like that? It's because I know that eventually I was Deontay at one point in time. I was him, where I was like, no, you just don't get it. But eventually I caught it. I remember the moment it made sense to me, where I was like, oh crap, and I know that moment's going to happen if you stick around long enough. If you have any kind of ethical compass, moral compass, it's going to happen. You're going to catch it. And so that's why I do what I do. That's why I will keep giving attention to people like Deontay. And even though Deontay, I wouldn't classify as a troll, he had good questions. He was really engaged. That's why I give so much attention to some of the trolls who, like, just do it, because I really think there's hope for everybody. There's hope for everybody. We could do this. So anyway, all right. Well, thanks for being here, guys. Thanks for sticking around. This is 2 hours.
One for the books.
One for the books. Awesome. Well, rock and roll. All right, guys. Well, once again, go ahead, click on the link. Go subscribe to everybody else. I look forward to seeing all of you guys coming through with your interest in life insurance and just getting clarity about everything you have going on. So that's